So what you have to basically remember in this, first is the discussion would be focused on calculation of that equity risk premium that we typically use in CAPM model, other models. So there are different approaches of finding out that equity risk premium, and for those different approaches there are different equations. You'll have to remember which approach uses what factors, and then the remaining part of the discussion is focused on how do you calculate cost of equity. So we've already seen some model. We know CAPM. Which other model do you know? How do you find out cost of equity? Yes, bond yield plus risk premium. So now they would introduce a lot of fancy models now. Fama and French model, Pasteur and Stamberg model. So then you have to remember which model has got which factors and how do you use that equation and what is the intuition behind each of the model. So let's start. This is the part of your first LOS. Find out what is realized holding period return, expected holding period return, and required rate of return. So we've done some discussion around this. And the return from convergence of price to intrinsic value, discount rate, and IRR concept. Let's start with first. HPR is a return earned from investing in an assets over specified time period. It can be of any length. This is a typical formula. Now, when I show you this formula, I have made one assumption. Okay, first let me explain what this is. Stock at the beginning of the year was 100 at time 0. At the end of the year, stock became, let's say, 120. And during the year, it gave you dividend of 10 rupees. What is the holding period return? What is the holding period return here? 30%, straightforward. That you've earned about 20 rupees here, capital appreciation, you've earned 10 rupees here, total return 30%. When I calculate this 30%, I'm making an assumption. Tell me what is that assumption? Correct. That what assumption I have made, that this dividend was also paid at the end of the year, or it was paid during the year but it was not reinvested, and therefore at the end of the year it remained 10. Are you following this? But had I received this in the middle of the year and had I reinvested, this 10 might have become 11 by the end of the year, and then my holding period return would have changed. So this is one concept. Now realized HPR means what you've actually earned, and expected means what you expect to earn for a given time period. Let's do an example for this. A stock price is 100 at time 0. At the end of time 1, it has become 150. Find out what is the holding period return expected. It is 50%. So holding period return is 50%. Now let me change one more variable. Now it has become 2. Now at time 2 the stock is 150. What is the expected HPR? Now it's time 2, not time 1. What is the expected HPR? It is still 50%. Correct. So HPR, holding period return, is not affected by the tenure. Of course, what we would write here is, I will say that this is 1 year expected holding period return. This would be 2 year expected holding period return. Are we clear with this? Required return is what investors want to earn. Minimum expected return an investor requires given the assets characteristics. If expected return is greater than required return, the asset is undervalued and vice versa. Make sense? Expected alpha is equal to expected return minus required return. Realized alpha, also called as ex post, actual holding period return minus required return. So again, in expected alpha we are using expected return. In realized alpha we are using actual HPR. You've realized this. So ex post, it has actually happened. No, no, not T2. Which means if stock price is 100 today, and after 1 year you expect it to become, let's say 120, then your expected return is 20%. Let's assume that if you require 10, then your expected alpha is 10%. But actually, by the end of the year, it became only 118. So then your actual HPR is only 18, and therefore your realized alpha would be 8%. Mohit. ठीक है? Are we good to move? Mark this question important. Okay, if you want, you can write down key facts of this question as well. It looks deceptively simple. Don't. Don't read this line, because this would change the meaning of the question. Investor in 1 year. Yes, how much? Huh? Yes, what is the answer? So what logic they've given? This sentence I shouldn't have put in the question. See what they are trying to imply here. This is an approximate calculation. I picked it up from an example. Your stock price is 100 today. The intrinsic value of the stock is 120. And which means that ideally the stock should have traded at a price of 120. And then as an investor, minimum that you expect to earn every year is 8. So because of perceived mispricing, or because of that mispricing, you will earn 20. Plus the fact that every year you expect to earn 8% on that intrinsic value, you will also earn that 8, and therefore in 1 year you would earn a total return of 28%. And that's why it was a bit tricky. Okay, so what it's trying to tell you is that if you don't read this line, currently the stock was 100, but it should have been 120. So by identifying this anomaly itself, I could earn 20%. Plus on this type of stock, every year I expect to earn 8. That's every year the minimum return is 8. So how much do I want? A 28% rate of return. Are we clear with this? Now see this. Let me just, so now let me say in 9 months. And these are approximate calculations. Yes. How much? 26. Now again the logic is 20 because of mispricing, plus out of that 8, which is per annum, you want to earn for 9 months. So you would earn approximately 20 plus this, you would earn a return of 26%. What we are not considering here is the effect of compounding. Are we clear here?
But since I am purchasing that stock at 100 rupees, doesn't that mean that I'm expecting the return to be 20% and my minimum return is 8%? That's why I'm investing in that particular
Hmm. So now logically tell me, if I tell you this way, that as per my valuation model, a stock is priced at 120 and required rate of return is 8%. Or let's, for simplicity, say as per my valuation model, stock today is priced at 100, required rate of return is 10%. What is the price of the stock you would expect after a year? 110. So the same logic, that as per my valuation model, stock is worth 120. I expect it to become 8%. That means after 1 year, approximately it should be 120 plus 8% of that. But we've just taken 8 as of now. So which means what am I earning? I'm earning from 100 to 120, 20 plus I'm earning 8, 28. Yes. So this is an approximate model. We are not doing exact calculation. That's how they've done it there. So if you do want to do it exactly, it would be 8% of 120, which should be about 10. So it would give you a higher return. It's okay. Huh? No, we've calculated this on 100 itself. 8%. What we've done is, just to make an approximation, we've taken 8 on this. So this is an approximate model. They've given a formula. The formula is difference between 120 divided by 100 plus the required rate of return. This is the formula which is given. So with this logic, this becomes 20 and 8. It becomes 28. But this is an approximate formula.
It means at the end of the year, there will not be any mispricing.
Correct.
Price will be traded at increase.
Yes. Yes. If that happens, then
Return will be 28%.
28% approximately again. Are we good to move? Yes, how much back there, Mrinal? आसान है क्या? कितना है मयंक? 158. करेक्ट. देखो क्या लॉजिक है, that you want to earn a return of 12% here. Your stock currently is being priced at 150. So to earn a return of 12%, how much should be the total return that you earn? 18. The total return that you want to earn is 18. Out of 18, you've anyways received dividend of how much? 10. So dividend is 10. So how much is the capital appreciation are you looking at? 8. So if current stock is 150, after 1 year stock price should become how much? 158. Is it clear? So question was flipped the other way around. Okay, next concept, the concept of discount rate. Okay, so this is a more of a generic term which is used every time you want to discount some cash flows. Okay, for example, we distinguish between required rate of return, we distinguish between expected rate of return. But when you use discount rate, what it simply means is a generic term which will be used to discount certain future cash flows. IRR we already know, that rate at which present value of inflows would be equal to outflows. And then see what does it say here. If the markets are efficient, then IRR would represent the required return, because then what you earn and what is required is same, and therefore the stocks will trade at intrinsic value. Is it making sense? Should we move on? Hmm? Since he wants to go for movie, उसको फटाफट ऑप्शन देके खत्म कर. सर सी. हाँ गणेश, what is the answer? Hmm. This is required rate of return means what? Required rate of return means what he should earn. Okay, what he should earn. So how is this calculated using CAPM or any other model? So if the stock is overvalued, let me put this a number. This is 20%. What is it that he should earn? Now, to make the stock overvalued, what he actually earns, should it be lesser than that or more than that? So HPR should be should HPR be 15 or should it be 25? HPR would be 15 because you're earning less than what you should be earning. So what should be the answer here? How many of you feel it's B? Okay, C. C is the answer. Yes, straightforward. See, you want to earn minimum of 20. If this HPR is lesser than that, if HPR is only 15, then the stock is overvalued. It's giving you less than what it should be giving you, which means that required rate of return would be higher than the holding period return. Is that okay? Is it difficult? No, it's not. No. Why does it have to be negative? No, 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 no. See, if you want, you can make this table. Okay. If the stock is overvalued, then required rate of return would be higher than holding period return expected. And if the stock is undervalued, then required rate of return would be less than holding period return. And it makes sense. See, don't remember this. Think of it logically. That get hold of this, that what CAPM gives you is what you deserve to earn on that stock for a given level of risk. So if your CAPM tells you that you deserve to earn 20%, but your equity valuation model tells you that in this year you would actually be earning only 15%, which means the stock is already overvalued. That's why it's giving you less. So when RR is higher, which means when HPR is lesser, the stock is overvalued, and vice versa. Are we good to move? Yes, do I have the permission to move on? Okay, thank you. Next question. Yes, what is the answer? C is the answer. So I thought we can have some fun with this irrelevant data. Equity risk premium using historical and forward-looking estimation approaches. So this is where that remembering part starts. Okay. See, now one practical assignment that I want you to do this week is go to Ashwath Damodaran's website. Okay, last time when I was browsing that website, I came across a PDF where they had calculated equity risk premium for about 50 countries. So just go and have a look at it to build a holistic perspective, and also search for equity risk premium for world. Okay, so on a global level, what is the risk premium that world equities are offering over and above RFR? Okay, so In curriculum, based on I think 2002, 2003 data, they've given that number to be about 4.1. I don't remember the exact number, but in that range. Okay, that on an average, global equities have given 4.1% higher than global risk-free bonds. That's what equity risk premium really means. So how do you estimate that? One way is you can use the historical data. For example, I want to estimate equity risk premium in India. So how is that calculated? Average return on equity markets, correct, minus the risk-free rate. Now there are multiple questions that would concern when I'm trying to do this. That when I calculate average return on equity markets, number one, what type of index do I use? Number two, what is the time period that I should consider? Number three, what is the type of average or mean that I should calculate? Tell me now. So if I want to calculate average return on Indian equity markets, what should be the index that I should consider? Yes, I can take either Sensex or Nifty because they would generate broad market. Okay, but of course, when I'm doing that, what I'm considering is that when I take Sensex, okay, which is made of those 30 companies, those 30 companies are the largest companies that we have today, isn't it? Let's say if I'm taking 10-year data, not necessary that before 10 years in 2003, the same companies were the largest companies. In fact, there is a possibility that there was some company which is not doing good anymore, which is not a part of Sensex. So when I'm doing this, there's a possibility of an upward bias. Are you following this? So a lot of index providers actually give you the index values where they eliminate this upward bias. So either you use that data directly or you adjust that upward bias with a statistical method. Are you following this? Second, what time period should I use? 10 years. Why? Okay, so again, that question would depend on what is the expected usage of your equity risk premium. So using that equity risk premium, are you willing to invest for a year or are you willing to invest for 5 years or 10 years? So depending on how you're going to use that, we will decide this. Again, what type of means do we want to use? Should we use arithmetic mean or geometric mean? Yes. So again, analysts will use both. Okay, though they've given one sentence at the end where they say that most of the analysts these days prefer to calculate geometric mean. And again, this using geometric mean as against arithmetic mean would create a upward bias or downward bias? A downward bias, because the geometric mean will always be lesser than arithmetic mean. Are we clear here? And then RFR. So we know that RFR we don't use corporate bonds, we use government bonds, isn't it? Unless and until you stay in Russia or Greece, you would want to use the government bonds as a measure for RFR. So then should I use 1 month T-bill or should I use a 20-year bond? Depends on what time period you had decided here for your equity markets. That means depends on what time period you are going to hold on to your securities. So all these factors are to be looked in when I'm using historical equity risk premium. So the equity risk premium is return over the risk-free rate that investors require for holding equity securities. It can be used to determine the required return for specific stocks. So historical estimates of equity risk premium. Difference between mean return on broad-based equity market index and the mean return on US Treasury bills over a given time period. So equity index to represent equity markets return. So what four issues? Number one, index. Number two, time period. Number three, mean. And number four, proxy for RFR. So what I've written in the bracket is based on the language what preference they've given. Okay, so they haven't given a specific preference. You need not remember this, but based on the whole discussion, I thought that this is the preference that they are trying to imply with that conversation. So here typically time period is long term, and type of mean that you want to calculate is geometric mean, and proxy for RFR would typically be bonds. Are we good to move here? Forward looking or ex ante estimates use current information and expectations concerning economic and financial variables. Now read this. This part I feel is extremely important from your exam perspective. The strength of this method is that it does not rely on assumption of stationarity and survivorship bias. Okay, so this is where they've linked you to your quant material, where you would come across the assumption of stationarity. What does this mean? Being stationary means being constant. Being constant. So there is an assumption of stationarity when you are using historical estimates. Why? Yes, because what you are implicitly assuming is that those macroeconomic variables that affected my numbers in the past, the same numbers would affect in future. That means you're assuming that that relationship is going to remain stationary. Are you following this? So when you're using historical estimates, let's say you are calculating returns on Sensex for last 10 years. Okay, so the factors which might have affected your returns on Sensex 5 years ago, not necessarily the same factors will affect it in future. So when you're using forward looking estimates, you are eliminating that bias. And what other bias you are eliminating? Survivorship bias that we've anyways discussed. Are we good here? So remember these 2 points specifically. Number 1, that for historical it assumes assumption of stationarity, and second, there is a problem of survivorship bias. Okay, so we will start with the forward looking estimates. This is where your formula remembering concept starts. So the first formula you remember is Gordon growth model. Okay, we've done this in the past. Now we are using Gordon growth to find out equity risk premium. Okay, so don't lose the big picture. We are trying to understand equity risk premium using forward looking estimates. So what is the formula given here? 1 year forecasted dividend yield plus consensus long term earning growth rate minus long term government bond yield. So equity risk premium under Gordon growth model, dividend yield for 1 year, long term earning growth rate, so D plus G minus the RFR. Now I'll simplify this formula for you. Are you done writing? See this carefully now. Value of a stock at time 0 is equal to D1 divided by KE minus G. Correct? This is the formula for Gordon growth model. If you simplify this further, KE minus G is equal to D1 divided by V0, or instead of V0 let me now write P0, which means cost of equity is equal to D1 divided by P0 plus G. Have you studied this formula last year? Yes, this is how you derive cost of equity. So they have done the same thing here. See, expected dividend yield D1 divided by P0, that's dividend yield, plus consensus long-term earning growth rate. So these two factors are giving you cost of equity. From cost of equity, remove RFR, and what you have is equity risk premium. So it's the same formula, they've just written it in a different fashion. Is the logic clear? Are we good to move? Alright, let's pick up the next model. Macroeconomic models. These models use current information but are only appropriate for developed countries where public equities represent a relative large share of economy. Yeah, and then it says mostly based on supply side estimates. So when we do an example, you would understand that better. But see, again, the big picture is that we are trying to find out equity risk premium. We first looked at historical method, which was simple, that return on markets minus RFR, historical data. Now we are looking forward looking data. So there are three approaches in forward looking data. The first one was Gordon growth model. We know how to calculate that, dividend yield plus growth rate minus RFR. The second forward looking model is macroeconomic variable. It says that macroeconomic variable will typically work for developed countries. Why? Because in developed countries, the equity markets and the GDP level would be co-synchronous or synchronous. Why? Because a large number of companies would be listed. Okay, so that's the assumption that they've given here. So there is one extremely popular model which you need to remember. It's called Ibbotson and Shen model. So first write down and then we will discuss about this. Okay. Ibbotson is the professor, I forgot, I think Yale University, and he formed a consulting firm called Ibbotson, which was later on taken over by Morningstar. You must have heard of Morningstar. Are you done writing here? Let's understand the intuition with this model. Okay, again, street smart model. Let's say a stock today is trading at 100 rupees. Okay, it's got EPS of 10 and price earning ratio of 10, and that's how 10 into 10 the stock price is 100. Now next year if EPS becomes 12, assuming P is constant, it has become how much? 120. So that's a growth rate of how much? 20%. Let's assume that when this EPS increased by 12, that's an increase of 20%, 10% of this was because of inflation. From 10, EPS became 12, so that's a growth of 20%. 10% of that actually came from inflation. The real growth in EPS was only 10%. It would not be exactly 10, it would be slightly less than 10 because of compounding. So what is he saying here? He's saying, let's assume your P ratio is constant. The P ratio didn't grow, so it's 0. Inflation was 10%, so 1.1. And expected growth rate in real EPS approximately, let's say 1.095. The total of or multiplication of these two would become how much? 1.2 minus 1. That means the stock price should grow by 20%. Has it grown by 20%? Are you following this? So the formula in a way is telling you the same thing, that if EPS increases, okay, let's say EPS increases by 20%, P remains constant, stock price will increase by 20%. EPS increases by 20%, P also increases, then stock price will increase by both increase in EPS as well as increase in PE. And then to this 20%, this is not my only income, because I'm earning from capital appreciation as well as I'm earning from dividend. So another 10% I've earned from dividend. So how much return should I expect to earn? 30%. But RFR is, let's say, 10, so my equity risk premium is 20%. That's the intuition behind the formula. Do you want to do it again? A stock price is 200 today. How is the stock price being derived? It has got EPS of 20 and it has got price earning ratio of 10. Next period, if this EPS becomes 30, let me keep a round figure, let me make this as 28. EPS becomes 28. Assuming that PE remains constant, stock price will become how much? 280. So from 200, stock price became 280. That's a growth of how much? That's a growth of 40%. Okay. Now, how will you judge that growth of, how will you find out that my stock is going to grow by 40%? In our example, assuming that inflation was 0, okay, then the entire growth of EPS is because of real increase in earnings. Is that correct? So this growth is how much? From 20 to 28, that becomes how much? 40%. And is my P ratio increasing? No. So P ratio is also constant. So 1 plus 0% into 1 plus 40% into 1 plus 0%, that will give me 1.4. Minus 1 will give me 40%. So this entire term which is in red, minus 1 is 40%. Plus, let's assume I have not earned any dividend, so 0. So total return that I have earned through this equity share is 40. Minus, let's say if RFR was 10, equity risk premium becomes 30. If now I can say that my EPS from 20 became 28, but that entire 40% is not because of, let's say, pure increase in earnings. Inflation is also increasing. So now let me say that inflation was actually 20%. Okay, so if inflation was 20%, how much is the real earning growth rate in EPS? How will you calculate that? Karo, 1.4 divided by 1.2. 16.67. So see, what does it mean? That my EPS was 20 rupees earlier. First, it will grow by the level of inflation itself. That my inflation will automatically push it, so into 1.2. Plus there's a real earning of 16.67, so into 1.1667. And if I'll multiply with these two, it will give me, 28. Is the logic clear now? Mohit? अभी कैसे समझाऊं यार? देखो, EPS would increase for two reasons. If earning actually increases or inflation increases. So the product of these two, 1 plus expected inflation plus 1 plus growth rate in real EPS, this will give you growth rate in nominal EPS, the product of these two. And if EPS increases by 10% and if P ratio doesn't increase, stock price will increase by 10%. But if P ratio also increases by 10%, stock price will increase in a compounding fashion. So the multiplication of these three terms here is nothing but capital appreciation. So this part you can write down. That the first three terms is nothing but capital appreciation of stock. So if I have to simplify this formula, what it eventually becomes is capital appreciation of stock plus dividend yield, because this expected income is nothing but dividend yield. So this is a total return that I've earned minus RFR is equity risk premium. Ibbotson and Shen model. Okay, so there is a question in the curriculum on this. So you need to remember these three variables: inflation, real EPS, price earning ratio, minus 1, that gives me capital appreciation, to which I add back expected income, which is nothing but dividend, that gives me total return, from which I reduce RFR, which gives me expected risk premium.
This is forward looking. Then that expected inflation again, will it not be tied down to that RFR, because RFR will take care of the inflation? I mean, when government bond yield we consider.
Yes, what you're saying is correct. There would be a linkage between expected inflation and RFR. Yes, but this term, so this equity risk premium is happening on a nominal basis, including inflation. This term gives me nominal price appreciation plus nominal dividend minus nominal RFR. Yes. Let's do an example. Let's say expected level of inflation is 10%. Expected level of growth in real earnings is 15%. Price earning ratio is going to remain constant at a level of 6. Expected dividend yield is 10%. RFR is 5%. Calculate equity risk premium using Ibbotson and Shen model. Hmm? 31.5. Yes. Let's solve for this. Expected level of inflation, so 1 plus 10% into expected growth in real EPS, which would be 1 plus 15%. Expected growth in price earning ratio, should I say 1 plus 6%? No, this is going to remain constant. This is extra data, irrelevant. So the total of these would become how much? 265. Minus 1 will give you 26.5%. This is my capital appreciation. Plus I will earn 10% from dividend. So that's 36.5 minus RFR is 5. So on equity, extra return that I'm earning is 31.5. Easy? No, no, not necessary. So had this been 2%, this becomes 2%. Okay. So in a base case model, we assume 0 if nothing is mentioned, but it can be a different number. A. All of you getting A here? Jijo? वो अनिकेत उसको कह रहा है हाँ बोल जल्दी जाना Alright, the next one. Survey estimates. Easy to obtain but can have wide variety of disparity between them. Okay, so let's make one consolidated flowchart for equity risk premium. Equity risk premium either can be derived based on historical data, or we can derive that based on forward looking estimates. If we derive from historical data, this is nothing but return on markets minus RFR. What four major issues we'll have in this? Number one, what index do we have to consider? Yes, time horizon. What type of mean or averages are we going to calculate? And the fourth one is, what is the proxy for RFR? In forward looking estimates, three methods we've looked at. Yes, the first one is Gordon growth model, correct? Yes, second one, macroeconomic model, and the last one is survey. Now for Gordon growth model, equity risk premium, we had a formula D1 divided by P0 plus G minus RFR. Macroeconomic model, we know that it works for developed markets. Okay, which model did given for us? And Shen model. So what is the model given? 1 plus inflation plus 1 plus increase in real EPS plus 1 plus increase in PE ratio minus 1 plus income, which typically comes from the dividend, minus RFR. And then finally survey based models. So if you remember this flow chart, you would remember everything about equity risk premiums. Are we okay here? Next says is required return on equity. So these are the areas we want to cover. So quickly make a note and then we will discuss each one of them. It's going to take us some time to get good grasp of these concepts. You want me to read out any part not visible? Is it done? Okay. Let's first discuss this on a broader level. In the earlier case, we learned how to calculate that extra premium, equity risk premium. Now, how do you use that and estimate required return on equity? So, all of you already know CAPM, capital asset pricing model, RFR plus beta into ERP, equity risk premium. This is the formula. We've discussed how to get RFR, we've discussed how to get ERP. What we need to discuss is the beta. Okay. Now, typically, how do we use this beta? So we would plot percentage returns on index on the x-axis, percentage return on stock on the y-axis, and then we will have these kind of variables. From these variables, we would try to draw a line in such a way that this vertical distance is lowest. This method is called OLS methodology. We will be studying this in your quant syllabus, optimum least square, and this line is called as regression line. Okay, so typically this regression line will have an equation in the form of a plus bx. So y is equal to a plus bx. A is this intercept, that even when x is 0, y would be equal to a. X is this independent variable and b is the slope of the line, and this slope of the line in this context is called as the beta. So what typical issues do you face when you want to calculate betas? Okay, so number one, that I need return on market here. Now what proxy do I use for return on market? So again, I'll have to choose a broad market index like Sensex or like Nifty. Second, that what is the time period that I should use? Should I take data of 5 years? Should I take data of 10 years? So what is typically being recommended is that most of the analysts will use 5 years of monthly data. Okay. In the curriculum, they've also quoted that Bloomberg, the default setting in Bloomberg is they give you 2 years of weekly data. Okay. Then once you've done this, now what will happen is, let's assume that after your calculations you got beta of 1.5, but this beta of 1.5 is based on last 5 years of relationship, historical beta, which means in the past when Sensex increased by 1%, let's say L&T increased by 1.5%, but this happened in the past. So does it mean that the beta will remain the same in future? No. So in statistics there is a tendency which is called mean reversion. Okay, what is mean reversion? That over time, that any data set, any value will tend to go towards its mean. Okay, and what is the mean value of beta? Beta of entire markets, it is 1. So if I've got beta of 1.5, this is a raw beta. What analysts will typically do is it will adjust that beta, and to adjust that beta, one popular model is this Bloom model. Okay, so what are we trying to do? Whatever beta you've got, you're trying to push it towards the mean value. That means push it towards the 1. So 2 by 3 into what raw beta you've got plus 1 by 3 into 1. So when you put it into this equation, what you get is the adjusted value of beta. Okay, and once you've done that, then that beta can be used and you can estimate CAPM, or you can estimate required rate of return. Now what if you want to estimate beta for non-public companies? Yes, what we studied in the previous year. Take a benchmark company, then unlever that, and then that unlevered beta, relever that again. Okay. Now one difference between level 1 and level 2 curriculum is, if you remember, what was the formula for unlevering a beta? Beta into 1 divided by 1 plus debt equity into 1 minus t. In level 2, that 1 minus t disappears. So when you'd be solving the level 2 questions, the formula is going to be beta into 1 plus debt equity. They do not typically do adjustment for taxes. Okay, so how are we going to do this? If you have a comparable company, it's beta. This beta of comparable company is made of the company specific risk, or let's say business type of risk, and leverage risk or financial risk. So you want to remove the impact of leverage, and that's called unlevering. So how do you unlever comparable companies beta into 1 divided by 1 plus DE? Then this is where you've got asset beta. Okay, the beta purely that reflects that risk, and what you need to do here is relever that by taking this beta and then multiplying with 1 plus debt equity ratio of your company or your company. Are we clear with this? Okay. So if you're okay with this, your beta part is done. This week you have the second practical assignment. What was the first one? The Damodaran's website for equity risk premium. Second, take 5 companies and calculate beta values using 2 approaches. One, 5-year monthly data, or 2-year weekly data. So that means you will get 10 separate beta values. And then you would realize that how distinct those beta values could be based on what methodology you use to calculate. Okay, so how do you calculate beta? There is a separate function on regression. Okay, so that regression function can be used to calculate. So this week I'll send you a short, it's a fairly simple function in Excel. So I'll send you a short clip of 5 to 10 minutes on calculation of beta. You can go through it and try to calculate. When you're calculating returns, for example, let's say index at the beginning of the month was 100. At the end of the month it became 120. So that's a return of how much? 20%. But this 20% is a discrete return, which means that you're saying that index became 20% on the last day, isn't it? But in real life, index was increasing every day. So what return you want to use is continuous compounding, and therefore in Excel, the function that you're going to use to find out return is 120 divided by 100 log normal. Okay, so this log normal function will give you a continuous rate of return, which would definitely be less than 20%. Yes, there would be 60 entries and 59 returns. Correct. Okay. Correct. No. See how we'll do it. First, go to either BSc or NSE site, download the data, monthly returns and weekly returns. Let's say that you have Nifty data values. 100, 120, 150, you have 60 such values, and you have written on a particular stock, again 60 such values. Then 60 values means you can calculate 59 returns for each of them. So 1 month return for Nifty would be log normal 120 divided by 100. 1 month return for this stock would be log normal let's say whatever the stock was, 60 by 50. Then you have these two values. This would be your x variable, this would be your y variable. Use Excel's regression function, put these returns on x-axis, this on y-axis, get a straight line and get the equation of that line. Okay, so it will come. Just practice. We have sessions on quant, but if you try to do it practically, you'll remember longer, plus you'll enjoy it more. Okay. Alright, so we've taken care of these parts. Now let's go on to multi-factor models. 4 of them. Is it becoming heavy? Yes? No? Do you want to stop? How many of you want to stop? Raise your hands. How many of you want to stop at the risk of affecting others' studies? Okay, let's stop for the day. Joking.